You've spent decades creating a huge amount of wealth, but are you financially free?
2026 is shaping up to be one of the most pivotal years in automotive retail.
Every single business unit within the dealership is under significant margin pressure.
Because when clarity is missing, even strong stores start to feel strained. "2026 is shaping up to be one of the most pivotal years in automotive retail, not because of any major one disruptor, but because so many forces are converging at the same time. Interest rates, policy uncertainty at both the state and federal levels, margin normalization, and real affordability pressures on the consumer. All of that creates an environment where leadership clarity matters more than ever. So, Dan, let's start with the financial side. What are you seeing around rates going into 2026, and what does that really mean for dealers?
On the financial side, interest rates might be a bright spot in 2026. And I think dealers right now are looking for some good news. And so if we take a step back, in January, we were forecasting 3 interest rate cuts in 2025, and that forecast is largely accurate at this time. And so in 2026, we're expecting the Fed to move closer to neutral and manage risks in the labor market, which we believe will translate into 3 to 4 interest rate cuts in calendar year 2026. So if you are holding debt right now, that's going to be good news. If you're looking to make an acquisition, interest rate cuts are going to be helpful, and everyone is focused on the consumer, and any interest rate cut is going to be helpful to them too.
Yeah, Dan, and what you're describing is exactly what we're seeing inside the stores. When the external environment gets more complex, internal alignment becomes the real differentiator. Groups with strong leadership depth and clear decision-making processes can respond to changing environments fast. Groups without it, they feel friction and bottlenecks, which create stress and often conflict amongst the teams, which ultimately impacts performance, especially when every deal is taking more effort.
Right now, sales volumes are above 2019 levels, while at the same time, it is taking a lot more work and a lot more effort to reach those higher volume levels because every single business unit within the dealership is under significant margin pressure. And so ownership, senior managers, every department needs to be perfectly aligned heading into 2026. So efficiency creates wealth. And over the years, dealerships have been a great place to create wealth. If you think about it, dealers are selling thousands of cars every year. You own very attractive pieces of real estate. You're capturing underwriting profit on reinsurance, and you're generating enormous amounts of income. You've spent decades creating a huge amount of wealth, but are you financially free? Remember, you can't spend wealth. In order to spend wealth, you need to turn it into cash so that you can buy the things that you need. And so if you are relying solely on a business for your income, to a degree, you are giving up some financial and personal freedom. Because when you have financial freedom, you are in complete control of the most precious asset you have, which is time and where you spend your time. And you can decide to work or not. And so being financially independent, having wealth outside of the business allows you to delegate.
And that point about financial independence really resonates with what we see when we work with dealers. When owners aren't fully tethered to day-to-day cash flow, everything about the way they lead shifts. They delegate more cleanly, they empower their key leaders, and they create more space for next-gen leaders to grow. It moves the whole organization from reactive to proactive.
And when you delegate, leadership grows and organizations get smarter.
For a car dealership, I tried to bring it down to the least common denominator, which is the consumer. If you don't have a consumer that can buy your cars, you've got some issues with your business. The consumer in aggregate is pretty healthy. If we think about income, debt to GDP for households, et cetera, and I'll go into more depth than that, we're in a good place. We are nowhere near stress levels we saw, say, at the tech bubble, kind of the beginning of the century, or during the great financial crisis. Now, delinquencies are up, but I think there's some mechanical pieces of the market that are impacting delinquencies. But good reason why this is good for you is that the average car buyer buying a new car is making $115,000 a year. Whereas, the typical US consumer is around $70,000 per year. So you're fishing in a more expensive pond for your clients. Uh, and with them being more stable and with inflation coming down, and to Dan's point, with rates potentially coming down, that sets them up to be able to buy a vehicle or to upgrade a vehicle. Uh, so if we think about debt to GDP or household debt to GDP, we saw a real spike around the pandemic. A lot of people were furloughed, they weren't working, et cetera. We had to force payments down to some of those individuals. We got to about 100% debt to GDP. Now, that's also because household wealth includes stocks and bonds, et cetera. So your financial accounts. And we know what happened at the beginning of the pandemic. No one knew how long the pandemic would last. We saw the market crater. Well, as the markets picked up, so has household wealth. Now we're down to about 67% household debt to GDP, which is much more normal and puts us back kind of back at the turn of the century where we were. And if you think about a consumer, if my stock portfolio, my financial assets are rising, if I have equity in my home, which I can guess, anyone who owns a home, their home value has gone up in most mortgage servicing areas, that they feel pretty good and can feel comfortable taking on new debt, i.e., a car. I look at the first kind of the most cyclical debt there is in the market. That'd be credit cards. Used to be, as a former banks analyst, we would look at the charge-off cycle, and it's pretty quick. You can tell pretty quickly if I'm not going to pay my credit card, if I'm going to go delinquent. And if we look at kind of the credit card data, spending is still up. We also know that debt to GDP is down, so that it's a healthier situation. If we look at where we are right now for credit card delinquencies, we are still well below where we were back kind of in the mid 15, 16, 17, 18. So we saw that spike heading into the the pandemic. Then you saw all the checks go out. Now I'm guessing that most of you listening today did not receive a check. I didn't receive a check. Dan didn't. But when you got those, what could you do? You could pay down your debt. We know that the Fed cut rates dramatically down to near zero. We call it zero interest rate policy, which made things much more affordable. Now, if you've got zero borrowing costs, you could carry more on a credit card. You could pay minimum payments. It wasn't going to hurt you. You could also bid up the price of goods and services. And I'm just going to go out on a limb and say that most of you probably benefited from that because of the scarcity of vehicles. I remember I had to wait 4 or 5 months for my truck. I won't say what brand because I don't want to bias anyone, but it took a while, and there was no bargaining. Yeah, I paid what they asked for the truck because I needed a truck. So we have seen delinquencies pick up in credit cards, but now we've stabilized. As I look at the delinquency on vehicles, we've seen it definitely rise, especially off of a bottom kind of in 2021. Remember, in 2021, no one was really driving to work. We were still kind of coming out of the pandemic. One of my favorite terms was work from home because I got to, kind of go out in the back, read a book, come back in, walk the dog. Now that we're back in offices, we're driving more. So vehicle prices, they were a little more reasonable until inflation and all that additional income. I can't take a vacation. I can buy a car. I can't go out to the beach, but I can add something to my home. So we saw goods and services inflation bid up. If you look at, and I'll provide the slides, if you look at the debt service, the loan amount, we kind of did it as like a big smile. The average cost of your loan payments was high. As rates went down, they fell and we're right back up. So now you've got higher prices for vehicles. You've got concerns with trade and tariffs and what that will do to the vehicle prices. Vehicle prices have gone up. That makes those things less affordable. Lower interest rates will help. Uh, we feel at Bernstein that people are going to be much more focused on the price paid. And we'll see, and we've looked in the OEMs what they're doing. It's trim packages. They're trying to maintain a lower price, not see a big jump up. So instead of me getting a toolbox and some step ups on my vehicle, I may not get those, but I'll be paying the same price. So I believe that the car industry, the OEMs, will try to keep their MSRP increases at a minimum so you can play into that market, which has good income and things are recovering with lower rates. Now, if I look at the delinquency rates now, we've leveled off, but we are still well below the peak of the great financial crisis. So this is not, some of this is normalization. If you look at credit cards, it's more like this. If it's, it's car loans, it's more like this. And if it's mortgages, it's much longer cycle. A lot of those delinquencies are for subprime borrowers. So in that K-shaped recovery, if you're making 115,000 a year and you have a home and that home is appreciated and maybe you have a stock portfolio, all those really support you being able to make those payments. Whereas if you're in the lower portion, subprime borrowers who may be buying used cars, it's going to be much more difficult. And last point I'll say is that with inflation coming down, wages, real wages, have actually grown. That means I can afford more. So even if I've got higher grocery bills, I can afford a similar payment to before. So to wrap it all up in a bow, we think that the consumer in aggregate is pretty strong, not getting stronger. And they've got a strong balance sheet, but it's really bifurcated between the haves and the have-nots, unfortunately, for our economy.
That context is incredibly helpful right now, especially when we look at what's happening inside the stores. What we're hearing right now from dealers isn't fear, but strategic caution. Rates aren't dropping fast enough to feel like real relief. Margins aren't bad, but they clearly aren't the pandemic highs. And affordability pressures means every single deal just takes more effort than it used to. At the same time, consolidation and OEM unpredictability are creating both opportunity and anxiety. But the real challenge isn't the market itself. It's how the market exposes internal gaps when conditions tighten. And that raises the real question. Is your leadership team truly aligned? Are expectations across the organization clear? Do you have real depth, or are some of the same people just being stretched thinner and thinner? Because when clarity is missing, even strong stores start to feel strained.
There's opportunity and anxiety. And in this environment, in our view, dealers do have a couple of options. There are many reasons right now to sell a dealership. Margins are very tight. Hiring and managing people is very difficult, and valuations are pretty good. There's also many compelling reasons to purchase more stores right now. Interest rates are coming down. The consumer is strong. These dealers know this business and they know their markets. And so it goes back to what you were saying is there needs to be alignment. And at the ownership level, senior managers, every operating department, all that needs to be perfectly aligned heading into 2026.
Exactly. And that mix of opportunity and anxiety is what we're hearing from dealers too. It's a tricky environment. And that's why alignment at the ownership and leadership level matters so much heading into 2026. Todd, building on everything you just talked about, consumer strength, credit normalization, and the sensitivity around affordability, can you walk us through the big forces you and Bernstein see shaping the auto market over the next couple of years in the US?
So some of the factors that we consider when we're talking about now, this comes from our internal research. It could be whether it's our bond analysts that are looking at buying the bonds of some of the OEMs, or our equity analysts, or our strategists like myself. Tariffs obviously impact the industry. If you look across the industry, where parts are sourced, where cars are manufactured will definitely impact margins. When we're looking for additional deals, the USMCA trade deal should be hopefully finalized in 2026. We look at where sales exposure comes from, where vehicles are manufactured, who will do well. You'll definitely have a leg up if you are mainly a US OEM versus a European OEM. They have a lot of issues when it comes to emissions controls, and that's a potential catalyst that I'll go into at the end for US manufacturers. Electrification, there's been if you live in California, it feels like everybody owns a Tesla because they blow by you and cut you off all the time. But, pickup has not been as strong as some would have hoped. And now with pricing, et cetera, it certainly appears like the internal combustion engine, the ICE vehicles and the hybrids will be doing better, uh, especially because you have an administration that doesn't prioritize those electric vehicles. Then we have to consider what's going on with China. They are the preeminent supplier of precious metals around the world. We've had some back and forth when it comes. That's going to impact batteries, battery storage, et cetera. So there's a lot of things that will have to be hashed out within the industry. Now, what do we think? We think that the tariffs are going to benefit U.S. manufacturers, the OEMs, and that costs will spread out through the entire value chain. As I said earlier, you've got borrowers that are stronger, but they're more price sensitive. So maybe that means less trim packages. And we think the regulatory environment in the U.S. is much more supportive. So if you think about, kind of the emissions controls, that's a potential where it's not important to the Trump administration. It is important in Europe. That's going to be a big leg up, we think, for U.S. OEMs. Um, Additionally, electrification, we don't think that's going to be a huge profit driver. Like EVs, that's going to be a cost center, but there'll still be incentives, et cetera. So that's some place to look at. But we think profitability is going to really be driven by SUVs and those ICE vehicles, maybe even hybrids. And then because of our constructive view on consumer, we think we've got to have some positive demand for vehicles. Now we walk through and we kind of look at this from I always say bull, bear, and base case. Base case would be that employment is steady. We kind of feel like we're at a stasis right now, full employment around 4.3% unemployment. But that will be the key to driving sales. We definitely think that SUV and ICE sales will pick up in our base case, offset by a lack of or slowing EV sales. And then margin improvement is really going to move towards those OEMs that are offering those ICE vehicles. The downside or the bear case, if we go into recession, what do you do in recessions? You buy the parts manufacturers. Why? Because I'm going to wait to replace my vehicle and I'm going to, do the parts myself, or I'm going to be going to repair my vehicle to extend its life. Used vehicle prices will probably go up. You have to offer more incentives for new vehicles, a more competitive environment. But that's when you should start sending out your reminders about, annual checkups and your maintenance for your vehicles, where we know it's a good margin business. Affordability pressures in a recession are definitely going to weigh, and prices of vehicles, although they haven't moved up a lot, it's still getting difficult, especially for the lower part of the K. You're not going to be picking up the lower end of the consumers. The upside case, well, then that's kind of the land of milk and honey. If we get lower unemployment and we have lower interest rates, financial conditions are easier, it's easier to take a 60-month loan as opposed to 5. You can extend your financing. There's a lot more flexibility when it comes to the internal financial companies that you're using at your different OEMs to finance those purchases. And we would see a re-engagement when it comes to EVs, we believe, along with strong pickup in both the hybrids and the ICE vehicles, and especially my favorites, the SUVs. If I look at kind of the trends, it looks like kind of the average total price in vehicles will level off, and we're kind of projecting that out to 26. Again, new car payments are like a smile. They've gotten back to where they were back in 2022. Uh, but it also looks like incentives can come down a little bit because you can have people with more affordability, especially in the bull case, the best case. Um, and finally, that looking at who will be the winners and who will be the losers, I would look at where your car's parts are coming from. If we look as an industry, about 53% of all the pieces in a car come from the US, another 24% from Mexico and Canada, and another 18% from other imports. I'd be mindful of where those other imports are coming from. I know that as a dealer, you can add lines. I don't know if you'd ever subtract lines. I'm definitely not a dealership expert, but be mindful of where you can focus and where your margins are strongest. We know that it's going to be. That's going to be the OEMs that have a lot of U.S. footprint, and especially Mexico and Canada, as long as President Trump delays or lowers some of those tariffs and understanding that a vehicle will cross the border several times when it's being manufactured. So, not a dour outlook. As long as we have this continued kind of stasis in unemployment and inflation that remains in check. I am not as rosy when it comes to my view of interest rate cuts. Why? Well, number one, we have no data. We just had the longest government shutdown ever. And you've got no data that's going to then inform the decision of the Fed. So I'm not in the, hey, we're going to do a December cut, definitely. And the market is definitely pricing that out as well. We're doing this on the 20th of November, and the markets were pretty weak today. Part of that was non-farm payrolls and the revisions downward of the last report and the belief that this report will be revised downward. And in the new year, neutral rate is where the Fed funds rate neither supports growth or deters it. That's kind of low threes. Our economist is at 4 cuts next year, which would bring us below that. I don't think that would happen unless we go to recession or we have a big spike in unemployment. So I've got a very constructive view on the markets and therefore on the ability to spend on new vehicles for U.S. consumer. When we think about bonds, you're gonna be able to spend your yield. When it comes to stocks, earnings growth, not gonna be paying more and more, and you're seeing that in your prices for vehicles, trying to keep those down. But that's pretty constructive as long as we have no major upheaval in the markets. Even then, we saw back in April during the big beautiful bill, a big downturn and then a big recovery once things were walked back. I don't think that the current administration could deal with both a recession and a down market, or a recession, unemployment, and a down market. So I definitely believe this administration has their eye towards capital markets and the economy. So I don't think they're going to be as tough as I think the opposition thinks they will be.
So pulling all this together, the strongest groups heading into 2026 aren't trying to predict the perfect scenario. They're focusing on building internal stability. And what that looks like in real terms is tightening communications so priorities are never fuzzy. Putting simple mechanisms in place that promote teamwork and cross-department collaboration. And intentionally building bench strength in GM, CFO, controller, and any other key roles in the dealership. They're also creating clear expectations and development pathways for next-gen leadership, aligning owners, family, and key managers around shared expectations, establishing governance so decisions become faster, less emotional, and more consistent. When those pieces lock in, the business becomes responsive instead of reactive. And that's the real advantage moving into 2026.
Heading into 2026, we think that economic fundamentals look good. And so interest rates are coming down. Core inflation is coming down and moving closer. We may not hit 2%, but core inflation is moving closer to that target. The consumer is, as Todd mentioned, is in pretty good shape, and we expect spending to be at a robust level. And geopolitics if we think back over the last 30, 40, 50 years, geopolitics can always be a problem. Generally speaking, a geopolitical event has very limited impact on the markets. And so heading into 2026, we think that there's room for some optimism.
Exactly. And if you want a quick, objective read on where your organization stands, leadership, alignment, and continuity, take the Dealer Growth and Continuity Scorecard and book a 15 to 30-minute readiness review at NADA. It's one of the fastest ways to bring clarity into 2026 and into your long-term future. And if you found this conversation helpful, be sure to like this video, subscribe to the channel, or drop a comment. Thank you for joining us.